Hey everyone, thanks for joining today. You're going to love this conversation with Jamie Blake, Vice President of Investments at JB Matteson. He's going to lay out some great nuggets on how they look at deals, what markets they're in, why they're in those markets, what's the one key metric they look at, and if they can get that right, it'll ensure that the deal makes sense on multiple levels. He gets into how he got into the business, how others can get into the business, and why they're in core plus versus a value add or an opportunistic type asset class. So stay tuned. I think you're going to get a lot out of this and enjoy it. Hey everyone, we've got Jamie Blake on with us today, and from JB Matteson. I'm going to hand it over to you, Jamie, so you can kick off on who you are, what you do, maybe tell us about JB Matteson and what the firm's about, and we'll get going from there. Kind of at a high level, we're just talking about commercial real estate and the market and the business you guys are in.
Yeah, absolutely. Thanks for having me on, Chaz. So my name is Jamie Blake. I'm a vice president at JB Matteson, which is a 60-year-old investment management firm based in the San Francisco Bay Area, focusing on newer construction, multifamily assets in the Western United States. Over the course of our history, we've built a portfolio now of about just shy of 3,000 units, about $1 billion in value. And we're actively pursuing acquisitions of newer construction multifamily communities in California, Oregon, Washington, Colorado, and Utah. So my responsibilities at JB Matteson, I'm in charge of sourcing new acquisitions across California, Oregon, and Washington. And then I also do the asset management for 4 properties that JB Matteson owns in Southern California, where I'm based.
All right. So, and how did you get into the business? How did you even kind of come into this role? Kind of what was your history?
Yeah, definitely didn't take a direct path into real estate. So can't say I would necessarily recommend following my path, but I studied finance as an undergraduate, and initially took a job as a banker doing mostly leverage lending for government contractors. And that was not a good fit for me, but um, ultimately was able to land a job at a triple net REIT doing acquisitions, focused a lot on credit risk. So my background as a banker, underwriting businesses and how they operate, was allowed me to get that role. And that sort of got my feet wet in real estate, which is where I realized that, sort of the more traditional real estate investment profession was what I was interested in long term. So from there, I went to UCLA Anderson for business school to get back to the West Coast. My first job out of business school was at Morgan Stanley Real Estate Investing, doing a lot of LP opportunistic investing on the acquisition side, as well as some core investments for their open-ended core vehicle. And then ultimately wanted to find something a bit more entrepreneurial, which led me to JB Matteson, where I now have a role where essentially I'm responsible for all things acquisition related, from sourcing to underwriting to managing the closing process for new acquisitions, and then ultimately asset management in my region after we acquire properties. So definitely not the traditional way to get there, but for people that are trying to break into real estate, I always recommend, this is a relationship business at its core. A lot of times, you're going to be most successful finding roles through referrals or soft introductions to people. And so just getting out and talking to people, asking for, 5 minutes of their time over the phone or for coffee can be a really powerful tool. And it just creates sort of that human connection that a lot of people in real estate really look for.
Right.
As a student, if you have a student email, that's going to be a huge advantage to get people to respond to you. So definitely, try to leverage your network either through your college or your business school program, whatever it is. And, when you do get those meetings, I think really what you can do is sort of control what you can control, which is, know about what's happening in the markets. Nobody's going to expect you to be an expert, but you need to be sort of just generally knowledgeable about what's going on. make sure you're pretty good with Excel and PowerPoint and sort of those kind of basic skills that will help you perform in that sort of entry level job, whether it's with a brokerage or an investment group or something else. Um, and as long as you show a genuine interest, a willingness to hustle, ability to go out and connect and communicate with people effectively, you'll ultimately be successful in commercial real estate.
Awesome. No, that great recommendations. And I liked your comment too that it wasn't a traditional path that you took. And it seems like in life that's how it often works, right? Here's the goal and where you're getting to, but it's never a straight line. It's zigging and zagging all over, right?
Absolutely, yeah. I mean, the first job for me was not a fit, but I learned a lot about what it meant to be, a corporate professional and work for a large bank and that sort of thing. So even if you don't start in real estate, there's always skills that you can position yourself as based on your prior experience that are relevant to real estate.
Absolutely. What when you pivoted into and kind of figured out you wanted to move into real estate, what was it about real estate kind of that stood out either as an asset class or investment category that you liked?
Yeah. So my favorite part about real estate is, I like to think of it as something that is very both left brain and right brain. A lot of finance jobs require you to have a really strong set of, analytical skills, um, be good with numbers, understand math, return metrics, modeling, all that sort of stuff. And I like that part of the puzzle of real estate.
Hmm.
But what I think is different about real estate compared to, banking or some of these other jobs is those models really translate to how people live and what they interact with in the world more so than with like operating companies.
Okay.
Um, and while the numbers are important, you can get a lot right about the numbers and still be wrong if you don't understand sort of the qualitative aspects of what you're buying in real estate, the location, physical characteristics of the property, what market you're in, and the future growth or lack thereof in that market. And so, real estate, I think, is just a great way to blend a lot of qualitative, quantitative analysis together in a rewarding way.
Right. And that kind of goes into something I want to talk about too for you is on the investment side or maybe the firm in general. How do you guys look at kind of key market indicators that kind of like speak to you guys in terms of, this is, where we want to make investments? What are things that jump out to you guys?
Yeah. So JB Mattison's platform is, lower risk profile, but definitely more on like core or core plus type investing compared to development or value add. So I would say a lot of what we're looking for are operational questions and strengths in certain markets, and then also defensive metrics. So, supply and demand is something that basically every real estate investor is going to be looking at relative to a submarket. How much inventory is there? How much is getting built? Is it being absorbed, used, that sort of thing. And while a developer might want to go chase, somewhere with a very little amount of supply or a lot of demand because it's sort of on an extreme and that's how their business model works.
Hmm.
We need to understand what that is going to look like, not only in the short term, but also over the long term. So
Right.
let's say our group places a heavy emphasis on supply in the short term, and then ultimately long-term sustained demand over a long period when we're looking at markets. So we might not be the first group to jump to the hot new market, just because there will be questions about what that demand looks like over a, 10, 15, 20-year hold period, which is really what we do.
Okay.
But markets that have a demonstrated consistent, population or job growth or whatever it is that has a real demand generator, those are the markets that are going to flag well for us, long term. And then it'll be about from there picking pockets or areas where we think the supply is appropriate or manageable in the short term, just to make sure that your rents aren't going to go backwards or you're not going to have huge concessions up front, that sort of thing.
Right. But so a couple of things, just for anyone who's not familiar, kind of on, you look at core and core plus kind of broadly, kind of what does that mean to you guys when you use those terms, kind of the type of assets? So you're probably not looking at something with the 1960s vintage, and that sort of thing. So what, if you just kind of broadly, what do you guys look at, core plus for you?
Yeah, I would say so. To me, the two characteristics that define how we view core are it's going to be an income focused return model. So
Mhm.
we place a heavy emphasis on cash returns. If you give us $100, how many dollars are we going to give you back in actual cash each year without relying on refinances or sales to generate attractive returns?
Mhm.
Ultimately, that's just going to be more defensive than, again, like a development business plan, which the majority of the return will be generated from the ultimate disposition of the asset. So we want to focus on consistent, stable, and improved cash flow. That means a lot of the mechanical systems, the roofs, pavement, that sort of thing are still going to be in pretty strong condition when we acquire them.
Mhm.
But also older than that, you start to see developments that, for example, like don't have in-unit washer or dryers, or might have like below 8 foot ceilings or popcorn ceilings, that sort of thing. And
Right.
so we find that those assets are just going to be harder to compete with, new construction in any market over the long term. So the combination of, you know, less capital intensive and then also product that is architecturally consistent with today's deliveries is sort of what we're looking for physically at
Got it.
least.
Perfect. So basically, you still want to be, because new construction's kind of always going on, and you still want to have a product that can compete against that. May not be that same level as new construction, but it's a good alternative for the similar tenant who's maybe priced out of that, but
Yeah,
priced so low they got to go to kind of the lower level workforce housing type of thing. Uh, okay,
yeah.
excellent.
So, and then the other part of core investing that I think is important to note is capital preservation. You know,
Mhm.
the inherent riskiness of certain other business plans leads to, downside cases that we do not think are appropriate for our investment model. So we want to make sure any, property that we acquire, we're confident it's going to hopefully grow, but certainly retain its value over a long time horizon.
Perfect. And for JB Matteson, did I hear that your time horizon on these investments is more in that 10 to 20-year range versus like a 5-year hold? Is that generally right?
So we're certainly, we're constantly in the market evaluating whether to dispose of portfolio assets based on any number of factors, the performance of the asset, our vision for how this market is evolving, changes in the regulatory environment. Obviously when we have upcoming loan maturities, we'll do a classic sort of hold sell analysis. But our goal really is to buy quality real estate in locations that we have conviction in, hold them for 10, 20 years, and then ultimately 1031 exchange forward into the next newer construction asset at the end of that 10 to 20 years.
Perfect. Perfect. Yep, that makes a lot of sense. What are so in terms of like so do you guys are you tracking pretty closely kind of inventory and new construction and the different markets you're in so you can kind of be adding that into your calculus as you're evaluating kind of what's the inventory going to look like, supply demand, and do you track that closely generally?
Yeah, so we're in all of our markets, we, track and are looking at market statistics at least quarterly, as
Mhm.
part of our investor reporting packages. On the acquisition front, I'm looking at them much more frequently than that.
Okay.
The construction pipeline, just as a broad comment right now, is one of the more difficult things to parse out. There's a lot of publicly available information on development in particular is not accurate. There are projects that are in planning that won't be capitalized or that are delayed and won't deliver when they're expected to and that sort of thing. So to really understand the supply of a market, you have to either, own and operate in the market or be sort of in constant communication with the investment sales market and our, contemporaries that are also multifamily owners in those markets. So that's something we're definitely thinking about and evaluating constantly, both, for new acquisitions, but also deciding on when and where to do like unit renovations or ultimately dispose of assets.
Right. Yeah, and that's a good point too. I mean, even on the broker side for us, finding good data is so difficult, on what's really happening, whether it's construction pipeline or, even, asset and ownership type data. It's very interesting kind of having the boots on the ground, like you said, operating in the market. That's where you really know what's happening. And is there a project that stalled or, did it not make it past the planning and approval process? Did something change in the marketplace? Like right now, it seems like on the development side, a lot of people are saying, hey, unless we get the land for free, or even if we get the land for free, it still doesn't make sense on the development side right now with the cost of debt and everything. So,
Yeah.
uh,
Yeah. I mean, certainly development is not our core business model, but you would have to think that, you know, it's hard to say if we have a functioning market right now, just because transaction volume across almost all of our markets is down so significantly. But, I think the majority of buyers for multifamily want to be at or close to positive leverage in the first year.
right,
And so if you're looking at development metrics, you're going to need to be 150 bips or so above what you think a stabilized group like JB Matteson would be able to finance it at.
right.
It's going to push you in the, high sixes, low sevens potentially in terms of an untrended return on cost, which is really difficult to make in most markets where you have flat or declining rents.
Yep.
Really
I think you're dead on. I
there's-
hear that from guys. Yeah, they're looking for, a 7% yield on cost kind of thing, so I think you're dead on that. Yep.
yeah, it's tough to find,
Yeah. Yes, it is. Are there certain markets right now? You guys are basically kind of the West Coast. I think I heard Colorado in there as well.
Mhm.
Are there multifamily markets either within Southern California where we are, or just the areas that you're covering that you have a preference for right now that seem the strongest for you, have a good story behind them?
Yeah. So, I would say when looking at we would acquire in all of our markets right now. Thinking about sort of relative cap rates to one another, I think we're seeing the most compelling opportunities in, call it suburban Utah, and then kind of greater Portland MSA.
Hmm.
Um, Both of those, I would say, are a function of understanding the supply pipeline and a belief that we have that the demand is going to persist in certain areas past the absorption of the supply pipeline.
Right.
Um, but then also just on a relative going in kind of cap rate type basis, they seem to be trading above where, some of our other markets like suburban Bay Area or the Inland Empire, Ventura County, kind of suburban Los Angeles seem to be trading.
Hmm.
And that relative value proposition feels compelling to us at the moment.
Got it. Got it. When you're looking and doing your evaluation on these different markets and opportunities, I mean, I assume interest rates are a big thing, but what are things that kind of go into your calculations and is your evaluation kind of thought process for these in terms of demographics and where's migration going or where's the population growth, where are the jobs going? Is it other things that people are got the common story I hear is, the Sun Belt, right? People retiring to the Sun Belt. So there's a big shift kind of out of certain markets towards that Sun Belt to capture, baby boomers who are retiring down there and relocating. And that maybe that's more for, senior living, but I think it's across the board too for other assets. How do you look at kind of, or what are the big pieces of the puzzle that you look at when you're evaluating these markets that make the most difference for you guys?
Yeah. So, I mean, certainly everything you just listed is a huge part of what we're looking at when we're evaluating submarkets, markets, locations. If you follow the demand, you always have a chance to be right. You know,
Yeah.
you
Yeah.
would certainly rather be in a place that has proven and sustainable demand than just low supply, but no real demand. Because if you get the demand part of the story right, supply will correct itself over time, especially in today's environment, as we just
Right.
talked about, where, you know, consensus is that very few multifamily starts are going to happen in 25, 26, 27 due to, inflationary cost pressures, declining rents, et cetera. So certainly the demand side of it is a huge part of it. I think the two things that we would also focus on that you didn't mention is the regulatory environment and also just the trend of where the regulatory environment is headed.
Good point.
Um, so, there are locations in Southern California that we've evaluated um, that screen well in a lot of ways, but essentially, nowhere is redlined essentially, but there are places where it would take a lot for us to take the plunge just because we think owning and operating over a 10 or 20-year horizon, it'd
Yeah.
be difficult to make real money doing that.
Yeah.
And some of those places are probably surprising to hear. But like I live in Santa Monica, for example, I'm not sure we would buy in Santa Monica simply because the operational risks of investing in the city of Santa Monica are significant.
Right.
Um,
Right.
and so that's a big part of it. And then the other one I would say is, in our experience, we've found that rent growth is more likely to occur where the affordability ratios are strong, even regardless of supply and demand metrics. So somewhere that is, has renters with proven demand who are paying, under 30% of their income on rent.
Mhm.
So in our portfolio, we've seen a much stronger ability to see rent growth over time when that ratio is lower when we are acquiring the property, um,
Yeah.
almost regardless of supply and demand.
I
So
guess it makes sense on some level because there's more room to push those rents, right? They can afford to pay
yeah,
more. If you're already maxed out, you're paying 50, 60% of your income on housing. How much more can you spend, right?
yeah. And
So,
it's almost certainly a leading indicator for out migration from certain markets as well.
yeah, absolutely. Yeah, that makes
Some
sense.
are expensive, and you got to move to a Sunbelt market. That's
Exactly.
not a lot
Exactly.
of it.
So do you monitor closely that, areas that have rent control or do you look at just kind of what are those in the regulatory environment, kind of where is it landlord friendly? Is that
Yeah, I wouldn't say it's necessarily has to be landlord friendly. We still own and operate throughout California and Washington, which have some counties and cities that, would not be on anyone's list as landlord friendly. But it's really just understanding what it means to operate in that area and how that affects your ability to actually manage a property. So, state of Washington, I think, is a good example right now, right? Um, there are concerns, and obviously they just passed a new rent control law in Washington, which is certainly not a good indication for like the political tenor of the state overall. But the actual details of the law, I think, are still conductive to us making, successful investments in that state. It excludes new construction for a significant period of our hold period. And even as it's currently drafted, you're going to be able to move rents 7% at a minimum. And we can certainly still make money if we're getting 7% lease trade outs.
yeah,
So
right,
while,
right.
the headline is scary, rent control coming to Washington, getting into the weeds of like what that actually means for owning a property in Washington is something that's of vital importance to us as we make investment decisions.
Absolutely. That makes sense. So kind of along that point of kind of evaluating deals and where it makes sense for you guys, what are some of the top considerations you make in terms of, are you looking at, so you're buying existing, you're not building new predominantly, right? So are you looking at what's the in-place cap rate? What's it going to be year 1, 2, 3, 4? Is it more IRR focused or a cash on cash return, a yield on cost? What are the important metrics for you guys as you look at opportunities?
Yeah. So our primarily we're focused on cash returns. So our goal is to deliver a 5 cash on cash in the first year of our ownership,
Okay.
which means a lot of different things at different points in time, especially with interest rate volatility. But generally, we've found that the other metrics that people are looking at, IRRs over a certain hold period, or equity multiples, or going in cap rates, per unit, per square foot type metrics, a lot of those sort of fall in line if you're able to find acquisitions that deliver that 5 cash on cash in the first year.
Got it.
So
So if you can achieve that, you'll kind of have everything else as well.
pretty much everything else is going to make sense.
Yeah.
If you can find that. And so that's sort of from like an underwriting metrics perspective, how we typically evaluate new acquisitions.
Okay. And you like properties 2000 and newer, ideally 2010 and newer, core plus. So what's like a typical kind of business plan when you acquire an asset as far as, are you having to do, a ton of upgrades, or is it as units turn, or is it you're buying newer products, you don't really have to do that as much initially? What's kind of a typical example of kind of what you would go through for a project?
Yeah. So I would say, we're typically not going to be underwriting a renovation program or significant capital at acquisition, just given our, vintage preference and sort of core plus type orientation. Um, that said, every plan is different when you buy it. We will almost always identify some projects that we want to tackle immediately upon acquisition. So a good example is last November, we acquired a BTR built to rent community in Ogden, Utah, which did not have a clubhouse when we went it under contract. But we structured our acquisition such that the developer had like an earn out essentially to build the clubhouse for us. And so a big part of our first year underwriting is, making sure that the clubhouse is built, furnished appropriately, changing sort of the property management expectations and operationally how it would run with a clubhouse versus without. And so like that's kind of a good example of like a first year business plan for one acquisitions. Always small nuances like that. And certainly, there's going to be operational changes when we bring in our management team and, get our asset management, lens on it. But typically business plans are going to be more about sort of like correcting operational deficiencies as opposed to major X renovations or anything like that.
You're not going in trying to put in 100 carports and trying to, put laundry rooms or, kind of do stuff like that. It's more operational and on that side, because you're buying newer product that already has that. You're not buying the functionally obsolete stuff that's out there, right? So
yeah, certainly I would say it would probably be a red flag for us as an acquisition if we identified some sort of glaring deficiency like that we didn't think we could, correct.
right. And that's a good point too, the red flags. What are other things that jump out at you guys and just say, nope, deal breaker, or at least red flag, we got to be real cautious going in on this.
Yeah, certainly, I would say our viewpoint on a lot of properties is that, when you're buying the stabilized property, it's telling you, the market has already told you like what the property can achieve. So I would say major red flags to us are any sort of underwriting that would require, major rent movements in the first year or significant retail leasing or, cutting expenses in half, anything like that. Like we're going to try, and certainly we're evaluating rents and expenses based on our portfolio and feedback from the market and managers and that sort of thing. But
Mhm.
I would say we try and stay as close to like the trailing 12 months performance on a stabilized asset as much as we can, because we're not trying to assume that we're going to be better than the current owner, who are largely, other institutional or reputable development firms in the Western United
Right.
States.
Right. Because you're buying these core and core plus products, you're dealing predominantly with, like you said, institutional ownership or large developers, not kind of a mom and pop owner kind of thing, right? For the
Exactly.
most part. Okay.
So I would
So
say something is sold to us as, tremendous upside just by, doing one or two things, and like, oh, the property manager is bad, just kind of like as a vague comment, like those to us tend to be red flags, because
got it.
usually it means the seller is trying to get you to pay for something that isn't achievable.
Got it. They're selling you on something, right?
That's their job, sir.
Yeah, exactly. So is when you're evaluating deals, well, let me ask real quick, like how many deals do you evaluate like on a weekly, monthly basis? I mean, you must see a lot coming across your desk and you're out trying to source things on your own. Um, I guess that'd be a second part of the question. How do you source deals in general? Kind of what's your process?
Yeah.
That'd be interesting to understand on your side, how many you're looking at.
Yeah. So, JB Matteson individually capitalizes each acquisition as a syndication, which means, we don't have a fund. So we don't also have a predetermined, deployment schedule of capital. So
Yeah,
we are going to pick assets and acquisitions opportunistically, like when we find things that we like, as opposed to, we have to buy 5, 6, 7 deals a year, something like that. Um, I would say, it probably takes us 50 to 80 properties that we evaluate before we find one that we think is worth buying.
okay.
There's a lot that fits our criteria, but there are also, just different motivations for sellers, different price expectations, different views on performance of the asset or where it's headed. And so we typically have to sort through, like I said, call it 75 properties before we'll find one that we acquire.
Okay.
Um, on a weekly basis, I would say look at anywhere between 10 or 15 kind of working on at a time. And
Yeah.
there's a few other people in my firm that are doing the same. So at
Okay.
any given moment, we're probably evaluating somewhere between 30 and 50 properties.
Right. I guess the good news, I mean, the challenging part for you is you're doing multiple states, multiple markets, but the good news is you're doing so many that you must have a very good sense of what a given market is, right? Just kind of, real quick. And kind of that leads into, do you have like a back of the napkin kind of way you can kind of quickly gauge something without really, doing your whole financial model on something?
Yeah, I would say, obviously I know what we're looking for very specifically, and I can probably find out if we're going to be, close to a deal in the first 30 or 45 minutes of looking at something.
Okay, got it.
Certainly, before we put in offers or participate in marketed processes, we spend a lot more time than that.
Hmm.
But, at a high level kind of first pass type thing, I understand the type of cash on cash return I'm trying to get to. I can look at what the property produced or is producing on like a T3 or T12 basis, and that should give me a pretty close approximation of what I think it's, a ballpark range of what it should be worth. And then comparing that to a seller expectation or pricing guidance is sort of what I need to start.
Okay. Now, since you have a longer horizon, that 10 to 20 years, how heavily do you look at like an exit strategy when you're on the acquisition side? Because a lot of times, you're going in with the exit in mind, right? Especially for groups that are more like on a 5-year business plan. Yours is a longer time horizon, probably tougher to project out 10 or 20 years. But how heavily does that kind of weigh in on your evaluation, or is it just, hey, we're in a good market, we have a good asset, we're confident in the growth story? So we don't have to have this exact kind of exit kind of set up, but we have a general idea of what's going to happen.
Yeah, I think that's a good way of describing it is, sort of in my earlier comment about how we think about underwrite metrics, if the initial cash on cash makes sense, typically, the reversion price in 10, 15, 20 years is also going to make sense for us.
Okay, so that fits in there too. So if you hit your 5% cash on cash return, that's your golden rule almost in this, right? You hit that number, everything else is going to fall in line.
Pretty close.
Okay,
Yeah. Um,
excellent.
and then I would say, if you think about like the assets life cycle, right? We'd like to buy it at the beginning, obviously, as it's newer construction. So most of what we're thinking about as exits is, how attractive is this going to be to somebody with a higher cost of capital, like a value add kind of renovation type buyer. And
Mhm.
that is, largely who we think of as our exit source for properties that are, 20 to 30 years old at the time that we're selling them.
Right, right. So it's not necessarily going to go to that core plus buyer. It's going to kind of go down the next tier, right? So
Yeah,
they've got a different business, which is interesting too, because in real estate, the great thing is there's lots of different levels where you can make money. So
yeah,
when you can be kind of the developer side all the way up to, you're going for the older vintages and heavier value add lift and or into the core plus and the core and it's more of an income stream and all that. So it's very interesting to see how many different layers there are and they're all profitable, if you're
it's a
doing
great
it.
part of the business. I mean, obviously I work on multifamily in the Western United States exclusively, but those comments apply to hotels, offices, industrial,
Yeah,
retail. There's something for everyone in real estate. I really believe that.
yeah, yeah, absolutely. So I know we're running kind of up on time here. I don't want to keep you too late. You got another 10 deals you need to evaluate today. So, but from your standpoint, and you hit on it a little bit, actually, before I get into that, are there any kind of with AI and everything going on, are you guys incorporating AI into any of your evaluations now? Or I'm trying to get a general understanding of technology and how that plays a role in what you guys are doing as well, or if
Yeah,
it,
I would
right?
say, much more on the asset management operational side of the business for us at this
Yeah,
point than on the acquisition side, mostly because, you know, I can do the work myself and figure out what I think something is approximately worth pretty quickly, and I don't have to like spot check, you know, chat GPT or whatever it is to make sure that,
right,
my prompt didn't get messed up or something like that.
right,
Um, Operationally though, it's definitely coming. We have some AI-based tools to help our asset managers, property managers, leasing consultants, follow up on leads and help with delinquency and stuff like that. So it's definitely a portion of the business that's going to change a lot. Um, the only thing is, in multifamily, it's inherently like a very emotional asset class. This is, where people are choosing to live and they're building their lives and, maybe their family is involved. So you have to be cognizant of trying to replace too much of that with AI and losing sort of the human connection on what actually builds a community.
right. I think
So
it's going to be more important over time too, because you're getting so much of that coming in now. People are losing that human connection and craving it more.
yeah,
You're right. Especially when you're close to home, even more so of that there. I
exactly.
think
Yeah.
that's a great
So
observation.
I think, perhaps it's not the most forward thinking, but a strength of we think our platform is, an emphasis on that community experience, heavy emphasis on sort of like higher touch residential experiences, adequate staffing at properties, training
Right.
on staff appropriately, that sort of thing.
Yep. I think that makes sense. And so, and you touched on it briefly, but if there's someone out there who maybe they've got an, an apartment building that they would consider selling and they've heard you talk and JB Matteson could be the perfect, buyer for them. But maybe you can just kind of lay out again, just kind of what you're looking for ideally, and then we'll touch base on how people can get a hold of you, and if they've got something that they may have to sell or have a question.
Yeah, for sure. So our website, www.jbmatteson, provides a great summary, but generally we are looking for 2000 or newer multifamily communities in California, Oregon, Washington, Colorado, and Utah. Typically 100 units or more. And that's sort of the only high level characteristics. We're willing to consider a lot of different markets, different structures. Special situations aren't necessarily off the table. We do have assets with a mixed use component, for example. So certainly, if there's anything that you think the world would like to show to JB Matteson, we're always happy to evaluate. And another part of what we do a lot from the investor side is accommodate outside 1031 exchanges. So certainly, if you have an investor that's looking to move into a more passive management role in real estate, it's worth a conversation and reaching out to our investment team as well.
Yep, absolutely. Perfect. Well, hey, I appreciate your time today, Jamie. It's been very educational and informative, and I can tell anyone out there who has an asset, JB Matteson is a great group. I know we've submitted offers on their behalf for other projects, so they're legit and a great group to get in contact with. And Jamie, thanks so much for your time today, all the education and giving us a deeper dive into your
Yeah.
life and how to invest in the deals and how to understand them and evaluate them better too. Appreciate it.
Yeah, absolutely. Thanks, Chaz, for having me. This was great. Really appreciate the opportunity.
All right, take care. Have a great day.
You too.
Talk soon. Okay, bye.